Hello friends, and this is CA Rajiv Khatlawala once again, and welcome to this section 2 of the course on financial markets for everyone. In the previous section 1, we discussed the basics of finance and investing, and I also introduced you to the various terminologies which are used by investors and also the analysts. And in this section, in fact, we are going to study more about the company financials and the basic valuations of companies. Before that, I would like you to note specific things. The first and foremost is that this is not a course on accounting methods or financial management or working capital management or even capital budgeting. What this course is all about is actually only on valuation of businesses. The basic purpose of this course is to introduce you to the company financials and the valuations so that as investors we can try to understand whether a company is valued, undervalued or overvalued. A basic understanding of financial terminology is assumed, and therefore if you do not feel comfortable, I would request you to please once again go through the section 1. All discussions in this course will be done with an ultimate aim of understanding company valuations. For instance, we might discuss various things. We will discuss about ratios. We will discuss about annual reports like balance sheet and profit and loss account and the various elements of those balance sheets and P&L account. But the ultimate aim is to understand company valuations. I presume that this caveat is already in place. And what are the prerequisites for this course? Well, once again, I would like to tell my friends who are watching this video, reading habit is a very important habit for the investor, and please try to read relevant news and analysis. And not only that, when you are a reader, please do not get influenced by the recommendations for a particular stock or for a particular investment, but the reading must inculcate in you the thinking process as to whether this particular investment is good for me or not. I would also suggest reading some books, not the Da Vinci Codes, etc., but non-fiction. Especially, I suggest to all my participants a book called One Up on Wall Street, and it is a book written by the legendary fund manager Peter Lynch. He was a fund manager of Fidelity Magellan Fund, and it is a very easy to understand book, and I would request that it is a good starting point. You do please read this book. It is available across the world. So what are we going to study in this particular course? The section 2 is mainly, as I said, about company financials and valuations. So the basic structured approach which we have taken here is, first and foremost, we will not start with any annual report or any balance sheet or P&L account or ratio. No, we will actually start with understanding the business models of various companies. Not only the business models, but we'll also discuss what are the various ways in which various companies in various industries grow. So the growth model of the companies is also important. Thereafter, once we are through this, thereafter we'll start with the basics of understanding the annual report, wherein we'll discuss the elements of the balance sheet, the profit and loss account, and we'll also understand what is a cash flow. Thereafter, we'll discuss about the ratio analysis, the various types of ratios which are normally calculated by investors, by analysts, and by various people. And our main focus here will be on valuation ratios. Thereafter, after doing these three basic things, we will come to the core of this topic, and that is the valuation. And in this valuation exercise, we will see some methods, some easy to understand methods, which also will include the stock screening methodology as to how to identify stocks using the valuation methods. So this is the basic structure of the course. I think this step-by-step approach to this company financials and valuation will give you a much better grip on how to value various companies. Before that, I think there is one caveat which I would also like to add here. And because most of the times what happens is that many people think that valuation of a company, buying a stock is something like, it is more about the financial figures. Not necessarily. In the process of valuing a company, financials play a very important role, but we do not stop there. In fact, it is only the starting point. Financial data gives us the quantitative glimpse of a company, but with this, we must go further and do qualitative analysis and try to understand the non-financial aspects which make companies valuable. A case in point, an example here would be the quality of the management. So that is an important part of the valuation exercise. A third aspect is putting our own intuition and our own calculated guess into our analysis. But I would also like to stress the fourth and the very important point here, and that is the perception. My experience is that valuation is a large part, it is an exercise on perception. I may evaluate a company and think that it is a very good company to invest in, but the market perception may be different from mine, and my evaluation in that case may not be relevant. Therefore, valuation of a company is nothing but a combination of all these factors. We start with the financial analysis, then we go to the qualitative analysis, we put in our own intuition and guesswork, and we try to understand the market's perception. A combination of this will give us the correct method of valuation. So what do we plan to achieve by carrying out fundamental analysis? What are we going to do in the subsequent sections? So broadly, we'll try to understand the macroeconomic picture. From that macroeconomic picture, we'll try to identify companies which will benefit from the growth of an economy. Thereafter, we'll try to analyze, once we boil down to the companies, then we analyze the company's past performance. We'll try to understand the financial data, the financial information, how it has performed in the past, what were the positives, what were the negatives, and we'll try, based on this, we'll try to anticipate the company's future performance. All this will be done with the basic aim of arriving at what we term as the intrinsic value, that is the fair value of a company. What is the company's worth based on our previous steps of analysis? Thus, basically, as I said, I will repeat here that fundamental analysis, company financials and valuation is an entire exercise on arriving at the intrinsic value of a particular stock. And if the stock price is less than the intrinsic value, then I will buy the stock. The lower the stock price, the farther away from the intrinsic value, the better value I am getting. And that is how most of the long-term investors have created wealth for themselves. So I hope this introductory session has given you a glimpse of what we are going to study, and see you in the next section. next session, I'm sorry. And see you soon. This is CA Rajiv Khatlawala signing off. Have a good day and best of luck. Thank you very much.